Okay, let us rock and roll. Okay, right, ladies and gentlemen, we are now in Learning Unit 4, Financial Management. First and foremost, I forgot to greet you. Good day, good morning, good afternoon, good evening, depending on what time you are watching this video. As I mentioned, we are in Learning Unit 4, Interest Rates and Bond Valuation. Fascinating, fascinating stuff. Now, this builds on your Learning Unit 2. Here we're looking at interest rates for the first part of this learning unit. And here they're basically highlighting that interest rates, right, are the expense or the cost of borrowing money for the borrower. At the same time, they are the compensation or the reward received by lenders, those providing the funds, okay? It says also, in turn, interest rates serve to regulate the supply and demand or movement of funds in an economy. Okay. And then another important thing that they highlight is that interest rates, all right, and economic growth, there is an inverse relationship between those variables. What do we mean when we say an inverse relationship? We're basically saying when interest rates increase, economic growth decreases. And when economic growth increases, interest rates decrease. Fascinating stuff. Now, why would that be the case? Could be several factors, but primarily when we have a positive outlook on the economy, we are going to decrease interest rates because there is less risk in the economy. However, when we have a negative outlook on the future of the economy, what do? We're going to hike interest rates. And you may have seen this not too long ago, all right? Over the COVID period, what was our Reserve Bank governor doing to counter inflation, all right? He would increase interest rates. And obviously that would contract the economy, okay? Right, and what has he been doing of late? Or soon after that, let me say, started slowly reducing it a little bit, okay? Because there has been a bit of a more positive economic outlook. All right, but enough on that. What else are we going to learn in this learning unit? The term structure of interest rates, risk premiums, the key inputs for the valuation of bonds, the basic bond valuation method, the yield to maturity, and the procedure used to value bonds that pay interest biannually. Lovely, lovely, interesting stuff. So I already highlighted to you that obviously the cost of money to the borrower is interest, which is obviously the compensation to the lender. Okay, but what else is it saying over here? We need to take note that the cost of money, cost of funds, cost of borrowing, interest rates, and the required rate of return are all used interchangingly in your textbook for this particular learning unit. And in general, to be quite honest with you, okay, all depends on the context of the discussion or engagement taking place. But what else are we learning here on this slide? You will recall that the cost of money comprises three main elements: inflation, a risk premium, and the time value of money. Okay, we're now connecting the dots with learning unit 2 and that of learning unit 4. In a perfect world, guys, there is no inflation, there is no risk. Unfortunately, we do not live in that type of world. And so as investors, we need to factor in inflation and risk into our interest rates. Now, obviously, we are just dealing with this concept from a theoretical level. So for you guys, all right, for your purposes, you will not be dealing with interest after tax, okay? However, in the real world, when you step into industry, you will obviously be looking at what is the interest rate after tax as well. Okay, now here we then open up with the concept of the real rate of interest. Okay, and this reflects the cost of funds to the borrower, the exact cost of funds to the borrower, all right, and excludes the effect of inflation. Okay, in basic terms, the real interest rate can be calculated by deducting the expected or actual inflation from the nominal interest rate. So if the nominal interest rate exceeds the inflation rate, the real interest is positive. Okay? The real interest is positive. So, in other words, if you're an investor, you are earning a positive return if your nominal rate exceeds the inflation rate. However, if your nominal rate is less than the inflation rate, that means that your interest rate, your real interest rate, is actually negative. Now, as financial managers, people who are tasked with safeguarding the wealth, in fact, also growing the wealth of shareholders. Our objective is obviously only to invest in a positive real return, okay, or positive real interest rate, okay. So do take note of that, okay. And then here, last sentence, they say an investor will seek to protect themselves against the decline in purchasing power of money, that being inflation. The cost of funds should include an inflation premium. Okay, all right. Then here they are now dissecting the nominal rate of interest. Okay, and they're basically saying it is the interest rate stated before the adjustment for inflation and without the adjustment for the effect of compounding. In other words, it is not the effective interest rate. Hello, does somebody remember something about what we learned in Learning Unit 2? Alrighty. And then there they have the formula. Okay, so your nominal interest rate is approximately your real interest rate plus your inflation rate. Okay. The relationship between the nominal rate and the real rate of interest can also be depicted by the Fisher formula. Okay. There you have your Fisher formula. Okay. There you have your Fisher formula. 1 plus the nominal interest rate is equals to 1 plus the real interest rate times 1 plus the inflation rate. Super, super, super. Okay, all right. Let's go on. The term structure of interest rates, very important. The term structure of interest rates describes the relationship and behavior of interest rates over time and over the and up to the date of maturity of the underlying borrowings or investment. Okay. If you turn to your textbooks to figure 4.1, you will see you have 3 curves. Okay. You have an upward sloping curve, all right, called the normal yield curve. This indicates that interest rates increase over time. All right. This implies that interest rates are lower in the short term, all right, and increase over time. This tends to be the norm, okay, when it comes to interest rates. They are cheaper in the short term and increase over time, okay, because we don't know what's going to happen in the future. So we generally associate risk to longer periods of time, okay. Then you have the downward sloping yield curve. This is where we now imagine that things are going to be not so great in the things are going to be better in the future. And so your interest rate is high today, okay, but things economically are going to get better, or we anticipate that they will be getting better. And so we have high interest rates now, but in the future, they are going to decrease. That's why we have the downward sloping. It's the inverted yield curve. It's also known as the inverted yield curve. All right. And here it says indicates that interest rates decrease over time. This implies that interest rates are higher in the short term and decrease over time. Okay. Then finally, you have a horizontal yield curve. Okay. Called a flat yield, or also known as a flat yield curve. Okay. Indicates that interest rates remain fairly constant throughout the term of borrowings or investment. Okay. Here we're basically saying we do not envision um, a, a change in the economic outlook. There is some uncertainty. Let me not say yes. Let me take that back. It's not that we do not determine no change. Sorry. It is actually there's uncertainty to whether things will be better or worse. Okay. And so we cannot say, okay, let's increase long-term interest rates or let's decrease long-term interest rates. So we just keep them the same. I've included in my formula sheet, which I will attach to my YouTube video, as I did with Learning Unit 3, a nice breakdown, all right, helping you with the different types of yield curves, their shapes, the economic interpretation, and then the investor expectations, okay? Very relevant. This is what a lot of economists obviously associate with the yield curve. Okay. And then here, many financial managers use yield curves for financial decision making, as summarized by the table below. Okay. Yield curve shape. If it's normal, then your financial manager will rely on short-term financing. Why? Because short-term financing is cheaper than long-term financing. Remember, we said long-term financing on the normal yield curve, the interest rates are higher. Okay. On your downward sloping or your inverted yield curve, the financial managers will actually take long-term financing. Why? Because they're cheaper in the long run and they're more expensive in the short term. Then flat, we're indifferent. The interest rate is the same, whether it's short term or long term. So we are indifferent over there. Okay. Then we have theories, all right, that have been developed that explain the structure of interest rates and what factors the slope of the yield curve is dependent on. These theories include the following. So we have the expectation theory, we have the liquidity preference theory, and we have the market segmentation theory. All very interesting concepts in and of themselves. So firstly, the expectations theory, all right, implies that the slope of the structure of interest rates depends on the expectations of future interest rates and or inflation rate movements. Okay. So what are they then saying? If the interest or inflation rate is expected to fall, then short-term rates will be higher than the long-term rates, resulting in the inverted yield curve. So remember, if we're saying inflation in the future is going to fall, all right, that means that our buying power will be stronger in the future. And so what are we going to do? We are going to decrease interest rates in the future because we know we'll have now more ability to borrow, okay? However, the interest rates in the present, all right, or in the short term are going to remain high. Can you see? That is your downward sloping curve. Conversely, if the interest rate or inflation rate is expected to rise, okay, short-term rates will be lower, okay, because presently inflation is not hitting us as hard, but in the future we anticipate that inflation is going to increase, okay, or is going to hit us hard. So therefore, our interest rate, there's more risk with high inflation, isn't it? Okay, so we are going to obviously factor that into our interest rate, which then results in the normal yield curve. All right. So our expectations of the future will dictate the yield curve. All right. Liquidity preference theory. What are we saying here? Liquidity preference theory explains why the yield curve slopes upward. Okay. The term liquidity describes how easy it is to convert an investment into cash. Okay. So liquidity preference refers to the theory that investors would prefer to have access to their money now. All right. So remember in Learning Unit 2, we said as an investor, right, or a provider of funding, you would prefer to have your money now as opposed to having it years from now or a period from now. Why? Okay. Because of risk. Okay. $1 today is worth more than $1 tomorrow. Why? Because of inflation and because of risk. We don't know what could happen to the rand between now and tomorrow. And hence why we say $1 today is worth more than $1 tomorrow. Now, that is why you would prefer your funds now. Okay, but what is it going on to say? I think I've labored that point. Generally speaking, short-term financial instruments are more liquid than long-term financial instruments and are subject to less interest rate volatility. Okay, because there's less that is likely to happen, less potential risk, and so they are exposed to less rate volatility. Investors, therefore, are willing to accept a lower interest rate for the short-term investments because they are perceived to be less risky. It's all about the risk. Okay. The converse is true for long-term investments. So this is strictly just explaining the normal, normal yield curve. Okay. All right. Okay. Then obviously market segmentation is not about risk at all. Here, let's see what they're saying. Market segmentation theory suggests that the slope of the yield curve is dependent on the conditions of supply and demand of different market segments, okay, relating to funds, of course. Market segments are typically split between those being short-term and long-term in nature, okay? Right, so you have the market that wants short-term and you have the market that wants long-term, all right? As the market segments operate independently, investors will need to decide in advance in which market segment they would prefer to participate. The more investors favor liquidity, in other words, money now, the more likely they will prefer to participate in short-term market segment, okay? So in other words, provide funding for the short term, okay? And if there's an excess supply of funding in the short term, all right, that means that there won't be a high interest rate, okay? Once this decision is made, the investor will be restricted to the particular market segment and will not switch segments, even if there are expectations of a future fluctuation in market interest rates. The implication of market segmentation theory is that there is no relationship between long-term and short-term interest rates, okay? It's all about demand and supply. Okay, now here we begin to discuss risk premiums, okay? And we know when it comes to risk, the more riskier an asset, an investment is, or a borrower is, the higher the risk premium. The less risk you have, then the lower the risk premium. Okay, so here we've just factored in our risk premium, all right, but this is the same formula for your nominal interest rate. Okay. Okay, so yeah, here they're just unpacking different risks. So you've got default risk, interest rate risk, tax risk, maturity risk. Okay. For example, in terms of default, when lenders, okay, so here they're just unpacking what default risk is, but we all know that default risk is the likelihood that your borrower might not pay back the money that you have lent them. And then what I want to pay attention is this last paragraph. Generally, the higher the risk factors associated with a financial instrument are, the higher the risk premium will be. And therefore, the higher the interest rate or rate of return will be. Okay. The required rate of return is significantly higher. Why? Because you are risky. Borrowing money too is risky. Investing in this particular investment is risky. Okay. The lower the risk, the lower the risk premium. But that said, let's park the bus here for a second and take a breather, and then we will continue with learning Unit 4.